if we look at the VIX now, and that's a standard, comparing it to the financial crisis, for example, it's different now. A simple indication is, and most people don't look at it, is to look not at the next 30 days, which is VIX. It only gives you an indication what the market thinks about the next 30 days. But if you look at the futures market on VIX, which provides you with a term structure of VIX, you look ahead. You look to August, September, October, the uncertainty is very high. The VIX index, compared to earlier crises, the VIX index shows that we still are going to be with big uncertainty if you go down the road towards the end of the year.
And how accurate do you think is it? And what kind of fear indication does it give us for investors and for the general market sentiment?
You see, you see a lot of, every day, you see somebody coming either with a prediction that we're going to get out of it very quickly, or the opposite prediction. So this wide disagreement is an indication, is another indication that it's going to be with us for a while. That's what the market tells us right now. It tells us, guys, you know, get ready for a long haul here about the economy, about the markets. It's not gonna turn around very quickly.
Do you think it's worse than 2008, the global financial crisis?
Well,
when you look at the VIX?
It's very different. If you look just at the VIX numbers, in some way they look similar. We had the peak of over 80 in the financial crisis. We had the peak over 80 here. Now, we had a decline, somewhat decline, and then it came back. We are having a decline here in the VIX, but it may come back. So we don't have enough data yet. So in some way, it looks similar. But the impression is that now, and here comes in ambiguity, which is, you know what, if you go back, people are quoting Rumsfeld, Donald Rumsfeld in the United States, that gave it a name and called it the unknown of the unknowns, to distinguish it from the known unknowns. Like if the known unknowns being VIX, let's say, and the unknown unknowns is ambiguity.
So you quoted Donald Rumsfeld. He said that there are the known unknowns and the unknown unknowns. And so I suppose for many investors out there, there is a category called risk and there is a category called uncertainty. But people don't really understand what is the difference. What is the difference?
So VIX is, we are assuming probabilities. When I do VIX, I assume the probability that the market is going to go up is, let's say, 50%. It's going to go down 50%. If you want to be more specific, you line out the probabilities. Ambiguity actually says, you don't know, you know what? I don't even know the probability. And I can give you a very good example from actually, how would you say it? From casinos, from a billiard table. Yeah. Take a billiard table. If since the billiard table is straight, there are 38 numbers on it. We know the probabilities. It's 1 over 38 for each number. We don't know the outcome. That exactly is what risk is. I either know or assume the probabilities, but I don't know the outcome. Okay. Ambiguity is when somebody tells me the billiard table is not balanced, it's tilted. So if it's tilted in one side, the probabilities of some numbers are larger and some smaller. But wait a minute, I don't know in what direction it is tilted. So I don't know what the probabilities are actually. I'm not sure it's 1 over 38. Could be higher, could be lower. On the average, it would be 1 over 38. But this additional uncertainty, the fact that I don't know the probabilities, is what ambiguity is. Now, in the economy, we never know what the probabilities are, but we are assuming them. Sometimes we are more certain what the outcomes are going to be or what the probabilities are. Now we live in a time that we have no clue what the probabilities are. I am working with a person who's a mathematician, economist, and so on, by the name of Professor Ishakian, and we've written a paper that was published about ambiguity. We came up under certain assumptions with a measure of ambiguity. And just a couple of points. In December 2017, VIX was very low. So you say, well, nothing is going to happen. Ambiguity was very high. In February 18, 2 months later, we had a huge jump in VIX, which we could say ambiguity has foreseen this. Ambiguity told us, look, something is going to happen. By the way, related to China, in February 18, there was a panic in the Chinese stock market, and they stopped publishing the index. The Chinese, the IVIX, they stopped publishing because of the panic in February 2018.
Yeah.
That's my example, by the way, what China should not do, and which is called kill the messenger. You don't solve the problem by killing the messenger, by stopping publishing the Chinese VIX. So
do you think that we should look at this new measure of uncertainty more than the VIX? Should we just look at ambiguity?
I think we should have both. They're complementing each other. In fact, it's interesting that when VIX is very high, it is in some sense, then ambiguity is also very high, because they kind of get together. They say, hey guys, there is so much uncertainty out there, whether you measure it by VIX or ambiguity, you get essentially the same idea.
So,
but
Professor,
the interesting thing is to see what ambiguity is when VIX is not very high. Does it give me an entire reading of the uncertainty or just a partial reading of the uncertainty?
Professor Brenner, I want to bring it back to New York for a little bit. We saw a little bit in 2008, and we see more now that the Fed is really going beyond its original functions and roles and the Fed is starting to buy junk bonds. We haven't seen that before. Yeah. And now you're talking about a Fed put. So basically there is a market expectation, well, whatever happens, if it's really bad, that the Fed is just gonna come in and bail everything out. And so in a way, that with the mentality of the Fed put, as we could see from New York Stock, the Dow Jones, that it's actually bounced back to almost all-time high now. And so with this sort of market expectations by investors, supposedly all the VIX, all the ambiguities, every basic market indicators give us any sort of directions about the movement of the market. It's going to be severely biased.
Well, look, I personally think that the Fed is doing, by buying junk bonds, in my opinion, it crossed a red line, because it's not only pumping in all that money into the economy, which some people are concerned about inflation and so on. I am concerned more about not just the moral hazard that we have in it, but I'm also concerned about the fact that these companies who, without the virus, if they don't get more efficient, they should go under. And you are keeping them on a lifeline, which is not helping anything. So I believe they went too far, and I don't think, I am not concerned about inflation for a very simple reason. I think people are not gonna, as much money as you give them, they're not gonna spend it. They're just too scared to spend it. People are concerned about their pensions, about the future, and the uncertainty of what is going to happen. Then, and it's not enough to just throw this money to revive the economy. If there's not going to be demand, that's not going to help. I mean, look at what's happening in the oil market.
Absolutely.
They cut production in the oil market. It doesn't help. There's not going to be.
So, Professor Brenner,
30% in demand. Go ahead.
So how do you reconcile the issue here, where you have, quantitatively come up with parameters to gauge into the future movement of the market, yet you are working with political mechanisms, these are sort of protection mechanisms out there, that essentially you could potentially face a scenario where the VIX is at 80. So what does it mean? The market doesn't go down.
The question is that the companies need to make new investment. They're going to stop making new investments, because right now the money that they're going to get is more to keep their employees, so they don't have to fire the employees, or they have to hold them at survival levels. Which company, with the uncertainty, even if you give them money, is going to make long-term investments? I don't think so. I don't think they're going to make long-term investments. If the demand is not going to increase, whether it's investment, whether it's consumer demand, and so on, look at Europe. Draghi, when he was the chairman, said whatever it takes. So they did whatever it takes. The European economy is there, but it didn't change much in terms of their growth. The European economy is still where it was in the last few years. Yes, they went out of some crises, but it didn't bring up the growth rate.
Yeah, so I suppose we have much to talk about in this area. But may I bring another question, Professor Brenner? You talked about Monte Carlo simulation. And so starting from 1980s, when you were trading actually on the floor, you said you were inspired by Black-Scholes model. That was then 40 years ago. And today, with the rise of AI, artificial intelligence, like say, in the corona crisis in China, Alibaba has come up with this AI tool that are able to predict coronavirus cases with 96% accuracy by just looking at CT scans. So with the rise of AI are supposedly, they bring in human behaviors. They don't have to rationalize into a formula. They just study millions and millions and billions of human behaviors, and they come up with predictions. And we are starting to see AI-driven asset management funds in the US now. Are AI going to replace us at some point in time, saying, well, you humans are not rational anyways, and so why don't we just study human behaviors and become better than all these indicators that we ever came up with?
Yeah, there are two things I want to say about that. One is the short term versus the long term. See, the companies have to make long-term investments. AI, of course, can make the process more efficient. But when it comes to long-term investments, you have to take a lot of factors into account. And that's what makes the economy go. In the very short term, there's no question that things have changed since then, and with all the high frequency trading and using AI and so on, makes the system much more efficient, okay? So news are reflected very quickly. Now, in terms of human behavior, I think that's one thing. I always have a problem with what's called behavioral finance or behavioral economics, because it talks about the behavior of an individual that does that. But the question is collectively. If you take everyone, especially people who are managing money, the professionals, it's already been shown in several studies that the professionals are making decisions somewhat, at least somewhat different than each of us is making. That's why they are professionals. They can cut losses where most people hesitate before they get out of the position, and so on. So AI makes the process maybe more efficient, but I don't think that AI would change the fundamentals, okay? So maybe the efficiency of trading will be much larger. And the fact is that most of the trading around the world, except, by the way, in places like China, where in China still the individual dominates the trading more than the institution or the professional. But if you go to especially the US, over 80% of the trading is done by institutional investors.
Let's talk about China, Professor Brenner. Yeah. You are a frequent traveler in normal times to China. You teach at the NYU in Shanghai. You taught me at the HKUST in Hong Kong. And you also consult for the Asian Development Bank. So how do you see the health of the Chinese economy and the pace of financial and economic reforms there?
Let me tell you, China has come a long way. There is no doubt. Actually, we had a discussion here with several economists how far China has come in a relatively, in the annals of nations, the period that they came by from where they were 30 years ago to now is just incredible. But China is still at the level, especially when you talk about the general economy, not just about Shanghai and Beijing, there is still a lot of room for the Chinese economy to improve and to grow. And China has a certain system. It's like a mix of some capitalism, socialism, whatever. I think just to do the process faster, it will be if China adopts more capital market principles. If it lets the economy or the markets say their word more than they do it now. And
would this also involve the abolishment, for example, and the breakup of state-owned enterprises, their monopoly?
That's true. There must be, and also, I'll give you an example. In this longevity risk idea that we presented in China, a big player takes place, the state-owned banks. So we, to drive our idea, we of course need to use what is available, and a big player in that are the state-owned banks. But if you, for example, take that, we should go forward and really privatize the banking system. If we privatize the banking system, China can move ahead much faster than it does. There's a lot of, we call it jump starting. It's true for many economies, especially economies where before you had less privatization, whether it was even Britain or the country I live in, Israel. There is a step where actually the government has a role, and the role is jump-starting new ideas, new processes that would not happen by themselves. You say, oh, the private sector, let's say I give freedom tomorrow and I say the private sector can do whatever it does. It's not going to work that much because the private sector may not be able to undertake these. So we say, you know what? Jumpstart it. You as a government, jumpstart an idea that at the end of it, you're out of the process. And the private sector came in and took over. But there's no doubt that China has to do more about that in order to advance faster.
And this will take a lot of time if it ever happens.
Well, you said China needs to adopt a series of market principles. So what are those principles?
Exactly. Look, I've been in China, as Martina mentioned. I've been coming to China now for many years. And when I started coming, one market that is close to my heart is the equity futures market. And at that time, just across from NYU Shanghai is the exchange, futures on the index. And I met the people there and we talked about it. In a short period of time, when they introduced the futures on the CSI, in a short period of time, the volume of trading was tremendous. In fact, it got to a point where they were trading more volume than in the US. And then came 2015, where the market declined, and the regulators said, hey, wait a minute, futures are actually contributing to the decline, which is not right, which is a wrong statement. But in a short period of time, all trading in that market has been banned. And the market really stopped. And from a huge volume, And the futures market really contributes greatly to the underlying market. There was a mistake. And, you know, steps like that. See, my kind of, there's a slide I show when I teach. I say, capital markets contribute to the main economy. Derivative markets contribute to the efficiency of capital markets. Therefore,
I think I remember that.
Yeah, therefore, you need
too.
derivatives markets. Look, I'll give you a very simple example.
I suppose they're contributing both on the risks and on the reward side,
Sure,
on both sides
sure.
as well. But
See,
Professor
go ahead, Shirley.
Professor Brenner, recently, as you have seen in China, there has been a real big financial event from Bank of China. Basically, you know, Bank of China has been buying WTI oil futures in Chicago for quite a long time. And so when the May contract came to a close, I believe it was around April 26th-ish. And so oil was trading at historic low over the past 2 centuries. It was at $37 a barrel. And then China had to close a lot of contracts, I believe 77,000 lots. And so over that period of time, China, inside the Bank of China, they have repackaged the oil futures into retail products to sell to individual investors. And all of a sudden, in the morning when investors wake up, they woke up to the fact that they not only lost all their money, they had to ended up paying millions and millions more to China to settle their contracts. And so that was something that was unheard of. Of course, coming back to your scenario, China is a very young country in terms of the experience of the capital market. And so this, of course, lots of public resentment at the moment from investors and really severely financial turmoil on top of coronavirus. And then with that, there's a lot of debate about China has commodities exchanges. We have big commodity exchanges in Shanghai, in Zhengzhou. So what would it take for oil one day to not to be traded in the US, maybe to be traded in China, maybe not to be settled in US dollars, maybe to be settled in RMB? How does that process actually will escalate over the next?
Let me tell you a couple of things. One, this event in April has never happened. There are things that sometimes happen, which is the first time they happen and you learn from them. It has never happened in the history of oil trading that a futures contract went into negative territory. And there was a specific reason for it. It has to do with the current situation in the world, with the fact that there is limited storage and so on. So it's unique to that. That's number one. Number two, futures trading, by the way, even in the US, is mostly not the purview of the individual trader, the individual investor. They don't trade in futures, even for one reason. People don't like what's called the marking to market idea, individuals, and so on. And I would say, I wouldn't, if you want to do it, if you're wealthy, okay. But I wouldn't recommend it to an individual trader. Most of the traders in the futures market are institutional investors, in particular hedge funds, dabble in that market. So, that's something that people have to take into account. So I would even, in terms of this one thing that I always say, a country like China, and I used to say it here when I was on the board of directors on the Tel Aviv Stock Exchange, financial education is a very important part of the evolution of markets and the economy. And one of the basic things is there are different instruments. Not everyone should be getting in those instruments. Futures is one thing, options is another thing. Individuals can get into options. There's limited risk. I buy an option. I don't care if the product goes to negative 30. I never pay more than I put in. But with a futures contract, the story is different. It could happen what happened. But it's really, by the way, it's unique to the oil market, the situation in the oil market. It's a lesson to learn. That's another thing which I always, talk about or preach, if you want, is we don't learn enough from the past. I'm not saying that the past always repeats itself. It doesn't. But we should at least learn the lessons from what happened and see to what extent it does apply to this period.
So, Professor Brenner, if we can learn one lesson from the past, from history, maybe the 2008 global financial crisis, that we should apply to the present day and the pandemic, what would it be in your opinion?
Look, one big lesson always, and that is what causes disasters and that is causes crashes, is leverage. And I'll go back even further. In 1998, long-term capital management, it was then the biggest hedge fund and actually the first known hedge fund, collapsed because they were leveraged up the gazoo. They were leveraged 25 to 1. You came to the financial crisis, aside from all the real estate issues and so on, Lehman Brothers collapsed because they had a leverage ratio almost double of what long-term capital had. Nobody learned the lesson that you should not be leveraged that high. So all the disasters come where you're super leveraged, okay? Look, the market is going to be going up and going down, and sometimes it's going to go up and down in a big way. The more you're leveraged, the chances that businesses will collapse are huge. The same is true for the junk bonds, basically. Okay? So,
Professor Brenner, you have such a substantial body of work. You've done so much research and you worked on the VIX and now ambiguity measure and so on. You're also a marathon runner and maybe even want to participate in triathlons. What is next for you? What's the next big idea and project that you want to work on?
Well, we are right, as I said, we started working on this longevity risk business, and we're trying to kind of expand the idea. And just briefly, there are many situations where there is basically the risk is on one side and you don't have on the supply side the same kind of risk. Let me explain it very, very briefly. If you take, for example, the demand for oil, okay, then there is clearly countries that need oil or have a demand for oil. China has big demand for oil. So you want to hedge that risk. If you want to minimize the risk, you want to hedge it. But then you have countries, especially like, let's say, Mexico and Russia and other countries who are on the supply side. So they have actually called it the opposite risk. They will suffer when the market goes down, while people who demand will suffer when the market goes up. Now these hedgers can match, okay? So they can basically be on the both sides, and that being on both sides means that actually the demander doesn't have to pay exorbitant prices because the supplier is also eager to sell his. By the way, in this whole thing, I didn't see them mentioning Mexico, but just for your information, Mexico has been consistently over the years hedging their oil production. Why? Because 40% of the budget of Mexico comes from oil. And if they let it go like now, they'll have no money. But they were hedging it all the years. Now, there are areas where you don't have an obvious other side. So let's say in the case of longevity risk, that's my point. Pension funds who, provide money to pensioners and so on, they don't know how long their cohort will live. Okay, there is a trend of an increase in life expectancy. But let's talk about above the trend and below the trend. People may outlive their life expectancy, or maybe live less than their life expectancy. But the pension funds are, of course, concerned about people outliving the life expectancy, then they won't have enough money. Okay, how do we hedge that? Who is the other side? So what happened over the past so many years is that they went out and they actually bought from insurance companies, they bought this hedge, call it, of longevity risk. So the big insurance companies either was directly or by issuing bonds which are linked to that. But what is the other side? The other side was just like selling insurance. They took the risk. They're not natural hedgers. They took the risk for a price. Because the insurance companies took the risk, you had to pay a higher price. But wait a minute. Can we find in the economy entities that have the opposite risk? That they make money when people live longer than expected, and they lose it. And just as an take pharmaceutical companies who produce drugs for the elderly. Well, if the elderly live longer than life expectancy, the pharmaceutical companies make money. In fact, they will lose money if they live less, which actually we have seen now that life expectancy in the United States has gone down. So now you can do a swap. You can take the pension funds who need it, combine it with some pharmaceutical companies, and you won't have to pay such a high price to insure your longevity risk. This is a general example. I'm not getting into details. There are, of course, when we get into details, a lot of issues to deal with.
We need a new Zoom session very soon. Professor Brenner, it's been a great honor and privilege to talk to you. You've always been not just a professor, but a mentor for me as well, since studying at the NYU Stern Business School and HKUST. So thank you so much for your time.
Thank you very much. Thank you, Shirley. Thank you, Martina.